And a very good day to everyone. Welcome back to Money Show's virtual Expo, your mid-year portfolio review. We are pleased to welcome Adrian Day, Chairman and CEO of Adrian Day Asset Management, a London School of Economics graduate. He heads Adrian Day Asset Management, specializing in global diversification and resource equities. Mr. Day is a sub-advisor to the Euro-Pacific Gold Fund. His latest book is Investing in Resources: How to Profit from the Outsized Potential and Avoid the Risks. Adrian, we're pleased to have you talking about this hot topic in the markets of gold. Thank you so much for being here. It's all yours.
Well, thank you very much, Mark, and thank you, ladies and gentlemen. I'm going to take a bit of a step back for part of this presentation and then look at where we are now and where I think we are ahead. And I certainly aim to leave time for questions at the end. So as Mark said, if you stick them in the box, he'll collate them and we'll get to that at the end. You know, the first line of my topic, what happened to gold? I'll just make a comment, if I may, about gold investors. And I'm a gold investor myself, sometimes a gold bug even. And one of the things that most gold investors share in common is that we're always disappointed with gold's performance. And so what happened to gold? Well, it's up 5% this year, which for an insurance asset is, in my view, really not that bad. Now, the gold stocks are a different issue. We'll come to that. But anyway, let's look first of all at gold. I said I wanted to take a step back. Let's look at what affects gold and what is affecting gold now and likely to affect it in the future. You know, if you look at an asset like bonds, it's really quite simple. Interest rates go down, bonds go up. And unless you're investing in foreign currency bonds, in which case the currency has an impact, you know, that's pretty much all there is to it, pretty much. If you look at stocks, a little more complicated, but again, you know, we look at the economy, we look at corporate earnings, and we look at liquidity in the system. And those things are the main factors affecting stocks. But if you look at gold, gold is unique in the sense that there are so many factors that affect gold. And if you ask gold investors, many of them have their own favorite. Oh, it's all about inflation. Inflation goes up, gold goes up. It's all about interest rates. If real interest rates are moving up, gold's going down, etc., etc. And all of the things on this list and many, many, many more do indeed affect gold, but they affect gold in different ways, which I'll come to, and they affect gold in different ways at different times. And I think that's important that we appreciate that. Gold really is the chameleon investment. It can be many things to many people at different times. But the one thing that is clear about gold is that it holds its value, its purchasing power over time. And if you look at this graph going back to, I think this graph goes back to 1560, and you can see, if you look closely enough, you can see the gold price, the cost of living, and then you can see the purchasing power of gold. And over 500 years, nearly 500, 450 years, it really has not moved up or down for any long period of time significantly. If we were to put up a similar graph for the dollar or the French franc or for the Japanese stock market or anything else, we would see a lot more volatility for much longer periods of time. This just illustrates this. It's said that 1 ounce of gold will buy a gentleman's suit throughout history, the Centurion all the way to James Bond. Now, 1 ounce of gold might not quite buy a Brioni suit, but it'll buy a pretty decent suit of clothes. And so throughout history, that has been true. The purchasing power of gold remains the same. Now, last year, I mentioned several factors on that first slide. Last year, we had a war in Europe and we had the cost of living going up. We had inflation, what's commonly called inflation. As Austrians among you will know, prices going up is not inflation, it's a result of inflation. But let's not go down that tangent at the moment. So we had two things, a war and inflation, but most investors would think should be pretty darn good for gold. Are they right? Well, if we look at geopolitical events, this is in the 70s and 80s. I know you don't have time to look at all of these carefully. I'm happy to send these slides to anyone who wants. And let me just give you my email now before I forget, is assetmanagement@adrianday.com. And I'm happy to send you the slides. But this is geopolitical events and the price of gold. And again, same thing in the 2000s. And the result, I mean, if you look at this carefully, you'll see that generally speaking, most geopolitical events, even very, very dramatic ones like 9/11, had a positive impact on gold. I hate to talk about a positive impact with 9/11, but they saw gold move up, but only for a short period of time. And the conclusion from all of these events, various geopolitical events going back to 1980, is that, first of all, the impact tends to be short-lived. Secondly, if there is a strong sense that the geopolitical event, which was unexpected, will have long-lasting impacts, gold might go up a little bit more than if it's clearly a one-off. And then lastly, and most importantly, geopolitical events tend to have a bigger impact on gold when gold is already in a bull market. The Iran hostage situation is a clear example of that. And so we saw last year when Russia invaded Ukraine, which was a surprise to me, and a surprise to many people, but it wasn't something that came completely out of the blue. You saw gold already moving up ahead of Russia moving their tanks into Ukraine. You saw a very sharp response, and then within 6 months, gold has basically collapsed. So this is a very good example of the impact of geopolitical events on gold. Now, what about CPI, commonly known as inflation? This is a graph of the 1980s, and you can see a pretty close correlation. We'll come back to this, a pretty close correlation between inflation, prices going up, and gold. Very close indeed. But that's not always the case. If we look at 21 and 22, yeah, there's some correlation, but it is a long way from being a one-to-one correlation, a long way. And so if we zoom in just on 2022, we see that the CPI was very high for the first half of the year, and gold was falling sharply during that period. We see the CPI start to come down in from September onwards into this year, and we see the price of gold go up. Again, this is a perfect example of what the previous slide shows, and many other periods of history will show, that gold and inflation is by no means a direct one-to-one correlation. And so I think we know what are the factors that stopped gold going up last year, and are they more important? Well, one is the dollar, and the dollar, this is last year, the dollar was up throughout the year from the invasion of Ukraine until September. And the federal funds rate, interest rates, were also moving up sharply. And of course, one might argue that the dollar was up partly, if not largely, because the federal funds rate was moving up. So these two factors, interest rates moving up and the dollar moving up, are what stopped gold moving up. And this is important to remember for when we look at where we are now and where we might be over the next 6-12 months. And And this graph this table is very illustrative because the gold last year was flat against the dollar. It was down against the Brazilian real, but for virtually every other, down against the Mexican peso, but against virtually every other currency in the world, it was up. And this illustrates the primary factor that affects gold. Gold has to be priced in terms of something. And it's the something and what's happening to the something that is the main factor determining the price of gold. We can see this clearly in this graph. This is all the way back to 1998. And you see a pretty close inverse relationship between gold and the dollar. Now, that's not to say, of course, that gold cannot go up more than the dollar is declining, that gold cannot go up against all currencies, even currencies that are going up against the dollar. But it's saying that the primary factor is to look at the currency in which you're denominating gold, in this case, the dollar, and gold has a pretty strong inverse relationship. So I wanted to get back to gold and CPI, and this is a graph I showed before. This is last year and this year. And again, to repeat, you see gold falling sharply when inflation was, CPI numbers were high, and gold moving up when the CPI came down. Remember this, bear it in mind, because I will come back to that to explain where we are now and where we're going in a minute. But first, let's just go back to the 1980s again, the end of the 1980s. And if you look at this chart, which shows inflation, interest rates, and gold, you see that certainly after the recession in the mid-70s ended, in 77, 78, 79, you see all three moving up very, very close in tandem. And it raises the question, well, if interest rates were moving up, why wasn't gold falling? Because that's what everybody says. When interest rates move up, gold should be declining. And then you see after that, 1980, we had the huge dip in federal funds rate, which didn't do anything for gold. And then the high interest rates under Volcker, with CPI coming down and gold going down. And let's just look at this table before I draw a conclusion. This shows you different years in the 70s. 71, inflation higher than rates. 78, inflation higher than rates. Then you even in 79, inflation higher than rates. And then in 1980, after Volcker came in, you see interest rates move above inflation. Now, gold was high at that point, but it came down very dramatically afterwards. And so the key is not the level of interest rates or where interest rates are going. It's not even, it's whether the market believes that the Federal Reserve is going to move interest rates meaningfully, sufficiently above inflation to kill inflation. All right. And that's what happened in 1980 when Volcker came in. Rates went to double the level of inflation, and gold fell from 836 all the way down to 240 or something. So where are we now? And then we'll look at where we are ahead. If you look at the core PCI, which is the metric that Jerome Powell and the Fed picked 2 years ago, I sometimes wonder if they wish they hadn't picked core PCI. PCI is Personal Consumption Index. core is inflation, or those numbers X food and energy. 2 years ago, when they focused repeatedly on core PCI, well, core PCI was below the headline PCI, and PCI was below the CPI. I can't help wondering if they picked that number because it was an easier target. Now that's no longer true. Core PCI is proving very, very stubborn, and in fact is higher than the PCI in general. But I guess having picked that metric, they can't reverse it when it goes against them. So as you can see from here, even with rates of 5%, having gone from over the last 12 months from 0, lower bound, to 5%, the most aggressive rate of interest rate hikes in history, it is still below the level of core PCI. And that's what's really critical. They decided to pause last month or earlier this month, as you know, and this graph, or this table, sorry, this is the dot plot. And this simply shows you this is the individual forecasts of the different Federal Reserve members, right? It's not a projection from the Federal Reserve itself of what's happening, nor is it Jerome Powell. I think Jerome Powell is now a little bit more hawkish than many of the members on his board. But if you look at this table, which comes directly from the Federal Reserve, and it has a thick line at 5.25, which is an error on the Federal Reserve's part. But you can see if you go across to the percents at the bottom, there's one member of the Fed that thinks rates will end this year at 5%. Most of them think it'll be 5.25, but the median is 5.6%. And Jerome Powell himself has talked about the possibility of two hikes before the end of the year. The problem, of course, is that with rates as high as they are, after the most aggressive rate of hikes in history, and Powell himself repeatedly says that monetary policy works with long and variable lags. The truth is that we have not yet seen the full impact on the economy of the hikes that have already been instituted. We have not yet seen those. I think Powell is well aware of this. This is why they paused this month, to give those lags time to catch up. But the truth is, these lags sometimes are 18 months to 2 years. And Powell has talked about higher for longer. And if we increase rates more, we keep rates high, and we increase rates more this year, even by another 50 basis points, which is only 10% of where rates are now, then we are only making the resultant recession worse. We are, in fact, or the Fed is, in fact, between Scylla and Charybdis in the Odyssey. Now, this, of course, is Homer's way of looking at being between two choices. We're stuck between a rock and a hard place. And that's Mick Jagger's way of describing the same thing. There is very, very little doubt, in my mind, there's very little doubt that the US economy is heading inevitably into a recession. And if we keep rates higher for longer, as Powell has said, remember, as rates are at a certain level, then the longer they're at that level, the more and more people have trouble at that level. It could be a company, for example, that has its loans, its debt coming due in 2025. Well, if it's got its debt that it took out when rates were at, let's say, 1.5%, an increase in interest rates doesn't really affect it too much until it has to renew that debt. So for some people it's 2024, for some people it's 2025. So higher for longer means that more and more people will be affected, and businesses and households will be affected by higher rates. I could show you 100 graphs, but I'm only going to show one right now that indicate very, very strongly that the US is heading inexorably towards a recession. This is the inverted yield curve. And if you look, the gray lines there are recessions, including the COVID, short-lived COVID recession. Before every single recession, the yield curve, this is the 10-year minus the 2-year, the yield curve went inverted. But before every single recession, where we are now is the most inverted by far since the early 1980s. In fact, since before the early 1980s, right? So two things. One, yield curve always inverts before a recession, and every inverted yield curve is followed by a recession. This isn't one of those predictors where you can say it's predicted 10 of the last 4 recessions. This predicts every one of the last recessions. Note the other thing, please note it. Note the lag. In each case, the curve was most inverted as much as a year or even longer before the recession. That's very important to understand. Now, we could look at other things. We could look at initial claims for unemployment that have shot up. We could look at the Conference Board's leading economic index, which is down for like 13 months in a row now, predicting recession. There are many, many things we can look at. My conclusion is that we are heading into recession. Oh, wait a minute, some people will say, aren't recessions bad for gold? Well, let's look at this table. This is the last 7 recessions in the United States. And you can see that in all except one of them, gold actually went up. And the one that went down, it went down by less than 0.5%. And that also was a time when the central banks of Europe, if you remember, were actually aggressively selling gold. So that's not a bad record. Now let's look at gold stocks, because you might say, well, okay, gold holds up reasonably well in a recession, but the gold stocks will get slaughtered. Well, not necessarily. Again, in a majority of the recessions, gold stocks actually did well, and in most cases, did very well, 37%, 44%, 190%. So the gold stocks did very, very well. I could take an average of these, but I feel personally, I feel averages of things like this don't really mean much. So the gold stocks have performed in most recessions, a majority of recessions, the gold stocks held up. And then the other thing to notice is that in every case except one, the gold stocks did better than the S&P. So there's no guarantee that gold stocks will do well in a recession, but gold will likely do well in a recession. The gold stocks are more likely than not to do well in a recession, and the gold stocks are very much more likely than not to beat the overall market. If you look at a table, so I think we're heading into recession. Sorry, before we get to this one, but let me just say, I think we're heading into a recession at the end of this year, beginning of next year, that will come before inflation is close to Jerome Powell's 2% target, which in itself is perverse in my mind for a central bank to want 2% inflation. But put that aside, we will get to a recession before we get to 2% inflation. Jerome Powell this morning, in fact, said he thought it was going to be 2025 before the core PCE is at 2%. And so we will have a situation of a weak economy and high or persistent or stubborn inflation, otherwise known as a stagflation. If we look at stagflationary periods for the last 50 years, we find the best performing asset in those periods is gold. And it's the best performing asset by a long way. The second one is other commodities. Now, gold stocks and commodity stocks, gold stocks are the second best performing, and commodity stocks would be the fourth best performing. And US bonds, US stocks, and major market stocks generally do badly. So I think the environment we're in, with the Federal Reserve caught between a rock and a hard place, unable to bring inflation down to its 2% target without causing a recession, is an ideal environment for gold, and it's a good environment for gold stocks. Now, gold stocks, some of you have probably seen this before. This is gold versus gold stocks all the way back to the end of the last, the end of the last millennium, I guess, but 1998. And you can see that gold stocks have significantly underperformed gold, starting since in about 2008, and in particular since 2020, they've also underperformed. So is it time to catch up? That's not, there's no certainty that we'll see mean reversion, but it's certainly worth noting that the gold stocks are undervalued relative to gold itself. The gold stocks are cheap on many valuation metrics. This is simply, this is the XAU, by the way, the index of leading gold, silver miners. This is cash flow. I could show you free cash flow, price to book value, earnings, a lot of other things. But certainly on a price to cash flow, the gold stocks today are well towards the low end of that ratio, going back over 20 years, going back 20 years, in fact, which is surprising given that gold is at 1950, given that, my next slide, given that the margins of the gold stocks are really quite strong right now. You know, everyone's talking about the price of oil and about, you know, inflation and so on and so forth. But the plain fact is that if a mining company is producing gold with an operating cash cost of $800 or $850 an ounce, or indeed its all-in sustaining costs of $1,200, $1,250, gold in 1950 is giving it pretty robust margins, and certainly on a historical basis. Again, this goes back, the dates aren't there, but this goes back over 5 years. You can see the margins are at the high end of that track record. And another thing about the gold stocks today, which is very unusual, is that on lots of metrics, dividend, price to book, price to cash flow, sorry, excuse me, the gold stocks are significantly cheaper, more undervalued, less overvalued than the S&P. And that is a very unusual circumstance, by the way, for gold stocks to be cheaper than the broad market, because people tend to buy gold stocks because they think the price of gold is going up. So the valuation metrics of gold stocks over time tend to be high. It's also worth noting that the XAU today is net cash positive. Again, a very unusual circumstance for mining companies, which are in a capital intensive business. So the conclusions from my talk are gold and gold stocks tend to do well in stagflationary periods. They tend to do well in recessionary periods. We are at a point now where the Federal Reserve is in a difficult position. If it keeps rates where they are and even increases them more this year, they are increasing the chance of a longer and deeper recession. And in those circumstances, gold stocks, which are remarkably undervalued today, are a very strong buy. And I'll quit there. Thank you very much. Do we have time for one question?
All right, Adrian, thank you so much. We do have about a minute here. One of our viewers, they said, if a gold makes a move up due to a recession, how long does that move up typically last?
Well, typically at the beginning of a recession, gold and gold stocks will fall, but then they will move up for the rest of that recession and into the recovery. So the decline, the initial decline might be a matter of 2, 3, 4 months, and is predicated primarily on whether investors think the Fed is going to start cutting rates because of a recession. So again, and that was an important point I made in the talk, gold's movement is primarily the result of investors' perception of whether the Federal Reserve will continue to hike rates or not. And so initially in a recession, you enter a recession when rates are already high, and so gold falls at that point. But after 3 or 4 months, it tends to recover and move up.
All right, thank you. And just one more quick question here. If you're wondering, do you see gold hitting close to 2,300, say in the next year, year and a half?
Well, you know what they say, give a price, but not a time, or give a time, but not a price. But yeah, I would say in the next year and a half, I think we're going to see gold. We're going to see gold move well above to 2,000 and 2,300. And listen, I'm really sorry I didn't leave enough time for questions. If anyone has any questions, please write to me at the email there, and I will do my best to answer them in the next couple of days.
All right, thank you so much. I also pasted that email address into the chat box.
Thank
Adrian,
you.
always a pleasure. Thank you so much for being here today.
Well, thank you very much, Mark, and thank you, ladies and gentlemen.
All right, have a fantastic one.
Thank you.